Making loans, creating a new loan. Let's look at this bank here. First National Bank, hundreds in assets, 100 in deposits. Let's say Bill Gates comes through the door and said, listen, I've got a new business idea. I want to make a new tablet PC. I need $200 or $200 million, whatever you want, but more than this here in cash. Question, can this bank give Bill Gates a loan over 200? Who thinks that the bank can't do it? More people? So that's how typical macro textbooks say it, right? The macro textbook says somebody is bringing money into the bank, and then the bank takes that cash money and gives it to somebody else. In practice, that's not at all how it works. If you're going to the bank and you want to get a mortgage of a few $100,000, never ever will the banker say, wait a second, I've got to count first how much cash I've got. What they're simply doing is they make a double booking entry. They say, okay, first of course they're checking that you're creditworthy, but let's say that's the reason why I took Bill Gates, you're creditworthy. They want to do business with you. What they're simply doing is they're writing down $200,000 or $200 million for Bill Gates as a loan, and we book it onto his deposit account. So we're just lengthening the balance sheet. Banks can do that, and that's called money creation. And it's perfectly fine. There's nothing illegal with it. It makes perfect sense. It makes the economy run much smoother. So some people, if you look at some of the news websites, or especially certain political spectrum, they are wanting to have the gold standard back, and they're saying money creation is bad and it's dodgy that banks can create money with a press of a button. But it's actually helping the economy a lot. Because in my example, Bill Gates might have had a very good idea, and he can do that idea only if he gets finance for it. So this is how banks basically create new deposits, new loans. They just press a button and they double book it on both sides. Now it links up a little bit to what you were afraid of. If this guy now wants to withdraw all the money in cash, is that possible for the bank? No, right? So if the transfer, all that big amount of money is transferred out of the bank, then the bank would get into trouble. But the basic creation of the loan and the deposits is easy for these banks. So we really link it up a little bit what we have learned in macro too. We say a certain reserve ratio. In Australia, we don't have a certain legal reserve ratio, and it's certainly not going to be 10%. I think in the US it used to be 2%. But we're just saying 10% to make our life easy here, and we are pretending even though in Australia there is no fixed regulation for this, this bank wants to keep a ratio of 10% of liquid assets to deposits. So let's see, if they gave out 500, 600 in total, 100 in cash, do they have more than 10% in liquidity here? So 600 deposits, 10% would be 60. They've got 100 in cash. So they've got plenty of cash, plenty of liquid funds. So from that point of view, the bank could give out even more loans. Let's flip it around. How many loans can a bank like this provide? How much deposits would be okay without violating this 10% rule? 1,000 over there, not just 100, right? 1,000 times 10% equals 100. Back to our example. So we gave a new loan, 500. We get new deposits here, 500. So again, these deposits are newly created. We don't need for somebody to bring us cash in, right? Now, why do banks do that? Of course, they want to earn money. So we make a simplified example here, where on the loan, the interest rate is 10%, and on the deposits is 5%. So they're earning 10% on the 500, and they're paying 5% on the 600. Just question here, Bill Gates in our example here. Does it make sense for him to get a loan at 10%, to save the money in the deposit account at 5%? Is that good business for you? Borrow money at 10 and invest it at 5? No, right? The reason, of course, he got the loan is not to keep the money on his deposit account, but to pay other people, to pay, for example, all the programmers. So he immediately uses these deposits to just pay his workers. If the workers are at the same bank, it's just changing names here, and we still have the 600 here, so we don't have to worry about it, just in case that you worry about where these numbers are coming from. 10, 5%. Keep that a bit in your mind. So what does a bank do here? Maturity transformation. And that links up to something that we did in the past, the yield curve. Remember, the yield curve is typically upward sloping. The yield curve has here on the one side the short-term interest rate, and on the other side the long-term interest rate. And long-term interest rates are typically higher than short-term. Deposits are short-term and therefore have very, very low interest rates. Savings account, term deposits, all very short-term, low interest rates. Loans, long-term, higher interest rates. So basically banks are so-called riding the yield curve here. And that's the reason why it's also important for banks that the yield curve is upward sloping. We see that in much later classes, how they can get into trouble. So that's the first thing, that you transform the maturity. They made out of short-term deposits, long-term loans. And on top of that, there's a risk transformation too. Loans, are they risk-free or risky for a bank? Is it guaranteed that the bank will get its money back? No, some people go default, right? For us, deposits, do you consider deposits risky? Are you every day afraid that the bank might not repay you your deposits? No, risk-free, right? So again, look at the magic here. 500, 500. Long-term risky, short-term safe. Right? How does a bank manage to get that safe? That's the next task that we do here now. For that one, we actually do need the bank capital. That's on the right-hand side, and there's a very small number. So how can we get bank capital? Well, we could either issue shares, as we did in the past in our class, so we can have an initial public offering if you have a new bank, sell shares, get bank capital in. Or we can have rights issue, sell new shares, additional shares, get more bank capital in. But most of the bank capital that the banks are getting, in all other companies too, is simply from past profits. Now let's see how we get the profits. We had depositors. We have to pay at the end of the year now all the depositors, 5%, and we had 600 deposits. So the interest payments for our depositors is $30. And we had $500 in loans. On these we earned 10%, which means $50. So if you make a profit and loss account, we don't need that in this class, but if you like it, right? So we earned $50 interest, we paid $30 interest, means we're getting a $20 profit. Or we can book it straight here. On our customer accounts, they're earning $30, so we have on their account at the end of the year plus $30 for our customers. But some of our customers have to pay interest on their mortgages, and we subtract $50 from their account. So all up, our new deposits will change from 600 to 580. And now we can calculate our bank capital. We didn't change any cash. We didn't change any of the loans. We have 600 here, 580 here, and the difference 20 must be bank capital. That's our net worth. Good. So we calculate bank capital. One way to calculate always simply assets minus liabilities, and then you've got the bank capital already. Exclamation marks, very important. So everybody in the news is always complaining that the banks are charging us way too much interest. Let's see what happened here over time. So we have here the so-called net interest margin. That is the difference between the loan and the deposit rate. And we see in the past here it was over 3%. Nowadays, closer to 2%. So that doesn't look like banks are too greedy, right? Interest rate margin went down, possibly due to more competition from foreign banks. And let's look over here. 15% return on equity. So return on equity, that's basically how much profits the bank makes as compared to how much shares it's got outstanding or for its bank capital. So return on bank capital, you might say. 15%, so quite high returns. Now, is that really that high? It looks good, 15%, but once in a while things can take a dip. So if you look at this one here in 2008, that's where the global financial crisis hit. So they used to have all these high returns here, down a little bit, right? And then back up. That's actually not even that bad. I think I've got a worse slide here. Bank share prices. Let's say you bought lots of bank shares because you think 15% return. I'm happy with that. That sounds good, right? Now you go along, the global financial crisis comes, your shares go down from 100 to almost 25. Now that's a massive plunge. And we see later, it's actually quite typical for share prices in banks to be quite volatile because banks have a lot of leverage. They have very small amounts of their own bank capital and a lot of deposits, which means they have leverage. And leverage makes things here more volatile. So there's something to keep out for. Yes, banks have usually high returns on equity, but also their share price is very volatile. That's for Australian banks here, majors, regional banks, but we can also see that all over the world. Here, 100 to, 40, also a massive plunge. And we do much more with the global financial crisis later. Good, so why is bank capital important? It protects depositors. So sometimes people say it protects the bank. It's somewhat right, but mostly wrong. Because if you have enough bank capital, what we see in a second is that the bank can survive, but the shareholders lose. So it's not really protecting the shareholders or the owners. Let's do that step by step. So we have a borrower here, the same borrower as beforehand, $500 he borrowed. That came onto our deposits. That's basically exactly the same bank as beforehand, right? So we have here 100, 500, 600, 580, 20 bank capital. But now we do something new. The borrower is repaying 490 only, and he says, I can't repay anymore, I'm done. Like my companies, let's say Bill Gates beforehand, worked with MySpace. I think they did buy MySpace, right? Turns out to be a total flop. Let's say they'll go into bankruptcy and they're gone. And all they can repay is 490. So step one, they do repay the 490. So we take the 490 off their deposit account, and therefore the loan is decreasing by 492. Now what's happening with the $10 leftover loan? Do we ever get that back? No, the company is gone already. So there's no point in pretending that we've got a $10 loan to that company, which they're never going to repay anyway because they're gone. So we have to book out the loan in total. That has to disappear. We don't have any loans towards that company anymore. So we have to book out the loan by 500. And we can do the same step as beforehand. We can now add everything up. We've got now 600 minus 500, so hundreds in assets. So we've got 90 in deposits here left that we owe other people. We've got 100 in assets. 100 minus 90 means we have 10 in bank capital left, which is exactly matching 20 minus the 10 in losses here. Now here we can see none of our depositors lost any money. So we didn't get called by the bank and say, listen, last year we gave a loan to Bill Gates, it didn't work out, sorry, we have to take some money off your deposit account. Right? So our deposits were 100% safe. We didn't lose anything. But you can imagine now what would happen to the share price if the bank loses half of its bank capital. Take a guess what would happen to the share price. Yesterday the bank's net worth was 20, now it's 10. So share prices, if yesterday each share was worth $2, now most likely they're worth 1. Right? So the bank basically halved its value here, net worth, so due to the leverage. And remember again, the economic function here, risky assets become safe deposits. The depositors didn't suffer at all. But that was because the bank had enough bank capital. Same story, just this time the borrower doesn't repay 490, only 400. So the bank is losing 100 in that sense. Let's check that again. We never get the full 500 back, so we have to book it out. We got 400 back of the deposits, so minus 400 here. And now we've got 100 in assets, and we've got 180 still in liabilities, and that's a problem, right? Because now we have more liabilities than we have assets. And a company like that is called insolvent. So these companies are not allowed to continue business. They immediately have to go out of business. That bank is done. Because their bank capital is negative. So as soon as your bank capital falls below 0, or in fact any net worth for any company falls below 0, that company is insolvent. And that would basically mean that the depositors now can't get $180 back. Not only because there's too little cash, but there's no other assets whatsoever. Of course, in Europe, Germany, and the US, we have something called deposit insurance. So the deposits are safe, simply by the government. So if the bank goes insolvent, the government jumps in and helps out. Anybody have an idea how it works in Australia? If your bank would go insolvent, Are your deposits guaranteed or not? It's important to know. So the following happened. Before the global financial crisis, the Australian government always said there is no deposit insurance. We will have never deposit insurance. It's the job of the banks to have enough bank capital here. It's not our job as politicians to bail them out. It's also the job of the depositors not to bring their money to a dodgy bank. They should do dealings with only good banks. But as soon as the global financial crisis came and people started to be afraid and started to withdraw their deposits, the government got cold feet and insured all deposits all over Australia, including foreign subsidiaries as well, for a limited amount of time. And as far as I know, small deposits are still insured by the government, so you don't need to worry. If you have very, very, very large deposits, they're not fully insured. It links up with deposit insurance in general. So there was a famous saying, there's two types of countries in the world. Countries that have deposit insurance and countries that they don't know yet that they will have deposit insurance. And the reason is simple. If you don't have deposit insurance, you hear in the news that your bank is in trouble, what would you do? Straight away. Withdraw your money. And not only would you do it, everybody would do that. And look at a typical bank. Combank, let's forget about the recent news. Are they solvent? Are they doing good business? You would think so. Commonwealth Bank, I think, are fairly stable, right? Nothing especially to worry about. Let's look at them. Deposits. 626 million. If everybody starts running to the ATMs, would that work? No. Remember, banks have only a tiny amount of deposits on the other side as cash. Usually less than 10%, right? So as soon as people start running to the bank immediately gets into trouble. It's called a so-called bank run. And that goes one step further. Let's say your bank is not in the news, but you hear from your neighbor. Your neighbor is with Westpac. He was at an ATM in the news. Westpac is in trouble. He tried to get money out on an ATM. It was empty already. You're with Commonwealth Bank. Can you sleep easy or would you run to? So typically what's happened is it's kind of contagious because people don't know exactly what the difference is between different banks. As soon as one bank starts to get into trouble, people are running to the bank too. And that's the reason why we typically have deposit insurance. The important thing here is we need to have enough bank capital, otherwise we start losing out. Bank capital is not there to protect the bank or the bank shareholders, because the bank shareholders do suffer. There's not going to be massive losses. It's there to guarantee the deposits, to make deposits safe. That's what the bank capital is for. So it's a buffer against insolvency. Ready? Let's look at the real world numbers. CET is Common Equity Tier 1 capital ratios. It's a little bit more complicated, but let's simplify it. Let's just pretend this is the percentage number of bank capital to total assets. And we can see here, less than 10%. Right? So banks have very thin capital buffers, you might say. Let's look at non-performing loans. You might think my example from before, it is a nonsense that there's so much of the loans non-performing. Ireland. Yeah, over 20% of the loans non-performing. Non-performing basically means they're getting into default, or at least partial default. Greece, over 30%. Now, if your bank capital is only 10%, you can see these banks in huge trouble straight away. In Australia and Germany, not so bad. Do I have the Australian numbers too? Not on this one. So Australia is much, much, much lower here too, Germany as well. But things can happen sometimes. Your turn again. So we've got two things now. We've got solvency risk and illiquidity risk. Let's check out these banks. A, B, C, and D. That's a little bit trickier. Try to find out which bank has solvency risk, which bank has illiquidity risk, which bank is super liquid, which bank is super solvent. Good, should we try together? So which one has the highest solvency risk? Which bank has the biggest chance to die? Who's in favor of bank A? Quite a few people. B? No one. C? No one. D? No one. So it's bank A, right? So if they just lose $1 of the 500, $1 default here, then they're already in trouble. $1.10, they're out of business, right? The fact that there's lots of cash doesn't matter, because bank equity or we are not allowed to let our bank capital fall below 0. Good, so which one looks the most solvent? Let's make it between C and D. Which one is more solvent? Lowest solvency risk. C or D? C, because if you look at this one, ESF, they're super safe anyway. The RBA, the Central Bank of Australia, they never go into insolvency. For the simple reason, they are the only ones allowed to print money, right? So they can never get into trouble. Here, we've got risky assets 200, equity 300. So even if you lose all the loans, if all of it is defaulting, this bank is still surviving. Speaking of liquidity, can this bank ever get into liquidity trouble? No. So this bank is super liquid, super solvent. Why don't we have all the banks like this? There's no risk for this bank anymore. Isn't that fantastic? What's the disadvantage if all the banks were doing business like this? They're hardly creating any money, exactly, right? So I don't want to buy bank shares. I'm afraid of bank shares. I want to have my money as deposits. And there's hardly any deposits created for the economy. Hardly any loans, too. They could create much, much more loans, but they don't. And that's not going to be good for business. If business are asking now if we want to have another 100 in loans and they say no, because they want to stay so safe, it's not going to be good for the economy. So yes, this bank is super safe, but they also, what do you think how much profits they make? Not very much, right? Hardly any loans, hardly any deposits. So there's just literally cash lying around doing nothing, right? So this bank is not necessarily good for the economy, not good for its shareholders either, right? So this bank hardly does any banking business. Remember, the banks are there to give us payment system, also maturity transformation. They do very little maturity transformation, very little risk transformation, right? It's more bank equity shares in this economy than in deposits. So that's not necessarily good for us. This one, most likely too risky. So which bank looks somewhat normal? I would say these guys here, they look fairly normal. They've got a little bit lots of cash lying around too. Question. So we're back to the example from before, and this bank is basically insolvent, right? They've lost 100 of their $500 loans. They got negative equity here, so they're out of business. And now everybody's wringing their hands and think like, oh my God, let's say if this is one of the big 4 banks in Australia, that would be, of course, a disaster. So the politicians want to help. And this example here, we want to lend them $100 in cash and at 0 interest rate. So we give them the money very, very cheap. And the question is, how does a new balance sheet look like? And did you solve the problem? If the Australian government gives this bank $100 in cash, lends it to them, how would we book that into the balance sheet? Let's do that together. Cash. Would I book the cash as liability or as an asset? Asset. So it's plus 100 here, cash. That's the first step. Do I need to change anything else? Well, for sure, because I need to be balanced, right? The question is, what else do I need to change? I could change the capital, plus 100, and then things would look much better than beforehand, right? But is that really bank capital that they've did? Lend. Where does lending go? Not that the lending the bank is doing, but the lending that the bank is receiving. So flip it around, the bank is borrowing from the politicians. Where would that go? Liabilities, right? We have to increase here 100 liabilities. And remember how we can calculate bank capital. All the assets, 200, minus all the liabilities, 280, minus 80. Nothing changed. So there you can see the big difference to illiquidity that we had beforehand. If you have an illiquidity problem, if you're just temporarily have too little cash lying around. We can just borrow cash from the RBA, from other banks. We can try to sell assets quick, right? We can get cash in quickly. But if you have too little bank capital, borrowing is not helping, because borrowing is increasing our liabilities the same way as increasing assets. We're just increasing both sides, but we are not solving the problem that we have too little bank capital. So the only way to increase bank capital is by selling shares or getting a present. So getting a present is called a bailout. So when the politicians say, we give you 100, you never have to repay us. That's yours now. Then we would do it like you said over there, plus 100 cash, and then we have 200 in assets, minus 180 in deposits, and then, by the way, sorry, not 100 in bank capital, but it would have brought our bank capital up to 20. If it was a present, which it is not. Right? Another way to do it is to try to issue new shares, to sell shares, because then cash is coming in, and we never repay that money. We're not promising to repay. But look at a bank like this. How hard or easy is it for them to sell shares? If you see in the newspaper, First National Bank insolvent, they're massively in the negative. They've got something worth $100, they owe other people 180. You can buy shares. Are you interested? No, nobody would buy shares in such a company, right? Because it was being negative business. Right? It's basically like getting an inheritance of your grandma's mortgage of $500,000 without getting the house. Nobody wants to have the mortgage. People want to have the house. So that just doesn't match up. Emphasis. So I know I pronounced a lot on these things, liquidity, solvency, reserves and capital. It's very important for this class. And it's something that people mix up. Students in this class mixed it up in the past in the exam. I saw even economics professors sometimes mixing it up in the news, right? And mixing it up because I really, not like a slip of a tongue, but a proper mix-up. So that's very important to me here in this class. Liquidity is something that is related to reserves, which is on the left-hand side, cash, ESF. Solvency has to do with capital on the other side, on the right-hand side. And they're two separate problems. They are a little bit linked with each other, but in your mind they should be separate. You should be able to answer all these questions as a self-check question. Recap. So what did we get out of today's class? Use the T count with assets and liabilities, and we see that the banks are transforming. They're transforming basically less liquid assets, like loans, into very liquid deposits. And they do that by having, for example, reserves. They also transform long-term loans into very short-term deposits. And they're transforming risky loans into very safe deposits. Now, all this transformation means that the bank itself is suffering certain risks. They suffer liquidity risk, default risk, and interest rate risk, which we will talk about in the next 2 weeks. While they're doing these transformations, basically this is a repeat here, so they do all these transformations for us. So a summary, T accounts, you should be on the board with the T accounts. Remember, equity or bank capital is assets minus liabilities, so always do that check calculation. That's the easiest way to do it. For us and firms, deposits are the same as cash and money. We like them. But for banks, they are not. For banks, deposits are liability. And for banks, the equivalent of cash is exchange settlement funds. The liquidity risk was the result of having much fewer liquid assets on the asset sides than short-term liabilities on the liability side. In other words, there is much less cash on the asset side than there is short-term deposits on the liability side. Solvency risk is describing the risk that assets fall short of liabilities. Since assets are not risk-free, the only way to avoid this situation is to hold some capital buffer on the liability side.